The warning signs never look like warning signs at first. They feel more like background noise, something you scroll past, something you tell yourself doesn't matter yet. But every crash in history begins the same way, with a quiet pressure building underneath people's lives long before the headlines catch up. And right now, that pressure is everywhere. You can feel it. Rent is higher, groceries cost more. Your friends joke about being broke, but it doesn't sound like a joke anymore. And somewhere between those rising prices and the constant fear of missing a payment, something unsettling is happening. Americans are cracking again. US household debt just passed $18 trillion for the first time in history. That's not just a number, that's stress sitting in the back of every Uber driver's mind, every college grad's mind, every parent with 2 jobs trying to stay afloat. Credit card delinquencies are now the highest they've been since 2012. And it's not because people suddenly got irresponsible, it's because inflation hit like a silent tax, wages didn't keep up, and the cost of simply existing went vertical. The scariest part? Gen Z, the youngest working generation, now holds the fastest growing debt of all. They haven't even lived through a real recession yet, but they're carrying more financial pressure than millennials did at the same age. That's not normal. That's the early tremor before the quake. And while everyday people are barely keeping it together, the system around them is beginning to shake in ways that feel eerily familiar. Regional banks, supposedly safe, have started wobbling again. New York Community Bancorp, NYCB, sent a shockwave through the market after admitting a sudden liquidity problem tied to collapsing commercial real estate loans. You probably saw the headlines but didn't think much of it. But here's what most people don't realize. Commercial real estate was the skeleton key behind the 2008 crash too. When buildings stop paying, banks start bleeding. And in cities like San Francisco, Chicago, and New York, office tower defaults are piling up at levels not seen since the Great Recession. Empty floors, unpaid loans, rising vacancies. It's the same movie, just set in a different decade. At the same time, millions of Americans just got hit with the student loan repayment shock after a 3-year break. That's not just a budgeting inconvenience. It's billions of dollars suddenly ripped out of consumer spending, the exact kind of demand that keeps the economy alive. When young people stop buying, the whole machine slows down. And right now, it's slowing faster than anyone wants to admit. But here's the part nobody talks about, the part that connects every one of these cracks. While normal people are living month to month and hoping nothing breaks, the same elite investors who made fortunes in 1929, in 2000, and again in 2008 are quietly positioning themselves to win the next crash. They know the pattern by heart, they wait for the world to get comfortable, they wait for debt to get bloated, they wait for people to stop paying attention. And then, when the pressure finally snaps, when fear takes over, they move. History's biggest profits were made during moments exactly like this one. Back then, it looked like chaos. But to the people who understood the system, it was a gold mine. Today, the setup is almost identical. The only difference is the generation that's about to live through it. And right now, the trigger is sitting in plain sight. We just don't want to see it. There's a pattern running through every major financial crash, a pattern so obvious once you see it that you start wondering why nobody ever teaches it in school. Maybe because it's not meant for regular people, maybe because it only benefits the select few who already know how the game works. But the truth is simple. Every crash follows the same 4-step cycle. Inflate, extract, collapse. Buy it all back cheaper. It starts quietly, with money getting easier. In the 1920s, syndicate traders pumped the market with borrowed cash, pushing stocks higher and higher until everyone believed the rise was normal. In the early 2000s, easy mortgages turned regular people into real estate speculators without even realizing it. And after 2020, near zero interest rates made money feel free. Stocks, crypto, housing, everything inflated at once. That's the first step. Make people feel richer than they actually are. Then comes extraction. While average people celebrate the boom, insiders quietly unload their positions. In 1929, the biggest investors sold stocks to the public at record prices. In 2008, banks packaged toxic mortgage debt into shiny products and sold them worldwide. Today, we're watching something similar. Major investment funds have been cashing out of commercial real estate while talking up the soft landing, and big hedge funds are placing huge bets on rate cuts before the pain even hits. When you see insiders selling while telling the public everything's fine, that's extraction in real time. Next is collapse the part of the cycle the public always pays for. When the debt becomes too heavy, when repayments fail, when confidence cracks, the whole inflated structure falls. We saw it in the sudden failures of regional banks this year, like NYCB's liquidity scare. One spark, and the illusion disappears. And finally, the last move, buy everything back cheaper. After a crash, the same players who dumped assets at the peak swoop in and buy the world on sale. Real estate, stocks, companies, sometimes even whole banks. It happened in 1932. It happened in 2009. And with household debt exploding and delinquencies rising today, the setup looks painfully familiar. It's the same pattern every time. The only question is where we are in the cycle now. In 1929, the stock market didn't just crash, it was pushed. Not by ordinary people, but by a tiny circle of operators who understood the game better than anyone else. Back then, Wall Street wasn't a polished glass tower with risk reports and compliance teams. It was a backstage magic show, and the magicians were men like Jesse Livermore, William C., Durant, and the quiet syndicates that moved markets in ways the public never saw coming. Jesse Livermore was the most famous trader in America, a guy who could read panic the way a musician reads sound. While average people were borrowing money to buy stocks at insane prices, he was studying the cracks. He saw the loans piling up, the insane optimism, the way every newspaper was yelling, "Stocks will never fall again." And when the moment came, he shorted the market, betting it would collapse, and walked away with one of the biggest trading profits in history. William C. Durant, founder of General Motors, played a different game. He didn't just trade stocks, he moved them. Durant and his partners used syndicates, private pools of money, to inflate prices, create hype, and make the public chase the rally. When the prices got high enough, they quietly dumped their shares while regular Americans kept buying, convinced the boom would never end. It was leverage turned into a weapon, optimism turned into bait. And then there were the shadow players, the syndicates nobody remembers. They borrowed massive amounts of money at tiny interest rates, bought stocks in bulk, pumped prices higher, and then sold everything minutes before the crash hit. When the panic finally exploded and the public lost everything, these groups stepped back into the smoke and bought distressed companies, land, and assets for pennies. That's the part history textbooks skip. The Great Crash didn't destroy everyone. It made the insiders richer than ever. And when you look at 2025 hedge funds shorting commercial real estate, billionaires hoarding cash, big players preparing for rate cuts, the pattern starts to feel uncomfortably familiar. Different century. Same blueprint. In 2008, the world thought it was witnessing a once-in-a-generation catastrophe. But behind the panic, behind the collapsing banks and the disappearing jobs, a small group of investors were following the same blueprint that began in 1929, just upgraded for the modern age. They didn't see the housing boom as a miracle. They saw it as a loaded spring waiting to snap. Michael Burry was one of the first. While the rest of the country believed home prices could never fall, he dug through thousands of mortgage documents and realized something terrifying. Many of these loans were basically bombs that would explode the moment people stopped paying. So he bet against them. John Paulson did too, placing one of the biggest trades in history, a short position that turned into billions when the housing market collapsed. Kyle Bass and Heyman Capital joined the wave, studying the weak spots in the system and preparing for the dominoes to fall. These weren't lucky guesses. They were the modern version of Livermore's 1,929 play. Look past the hype, find the rot, and bet on reality. Then came the banks. On the surface, they were the victims collapsing, begging for help, warning that the whole economy would fall without a bailout. And the government stepped in with hundreds of billions in emergency support. But instead of using that money to fix the damage, many banks used it to buy back their own stock, pushing their share prices higher while millions of families were losing their homes. The system collapsed for regular people and quietly rewarded the institutions that caused the collapse in the first place. And the final act of the cycle? Private equity. When foreclosures surged, big firms swooped into neighborhoods across the country, buying homes in bulk for pennies on the dollar. Entire communities were transformed into rental empires almost overnight. What felt like tragedy for ordinary families became a shopping spree for investors who had been waiting for the collapse. Now look at today. Private equity giants are already raising record distressed opportunity funds, preparing to buy the next wave of discounted assets the moment things break. They're not guessing, they're expecting it. The 2008 crash wasn't just a disaster. For the people who followed the playbook, it was the most profitable event of their lives. And the setup for 2025 is starting to rhyme. If you really want to know where the next crisis begins, don't look at the stock market. Look at the pressure points. Nobody wants to mention the ones hiding under headlines, under optimism, under this strange national belief that everything will somehow work out. Because today's setup doesn't look new. It looks recycled. Start with commercial real estate, the quiet giant. Across the country, downtown towers are half empty, yet billions in loans on those buildings are coming due. Many landlords can't refinance because interest rates are too high and banks don't want the keys back. This is the same ingredient that helped blow up 2008 loans built on assumptions that no longer exist. Now the clock is ticking again. Then there's the banking system itself. People think the regional bank scare ended with Silicon Valley Bank. It didn't. U.S. Banks are still sitting on over $500 billion in unrealized losses. Losses big enough that one wrong move, one panic, or one failed refinancing could break something important. NYCB gave us a recent preview when a single commercial real estate shock nearly toppled it. Corporate America isn't doing much better. Bankruptcies are rising at the fastest pace since the pandemic, especially among companies that borrowed heavily when money was cheap. Now those debts are coming back with higher interest rates, and the numbers don't work anymore. When businesses fall, layoffs follow, and young Americans already know that story too well. Tech layoffs have swept through companies that once promised infinite growth, leaving 20-somethings staring at rent bills that look like mortgage payments and grocery prices that feel like some kind of prank. Meanwhile, household stress is quietly building. People are using credit just to stay afloat. Savings from the pandemic are gone. Delinquencies are rising. But the stock market? It's acting like recessions are optional now, like the economy will magically soft land because people want it to. This is the part of the movie where the audience leans in because they've seen this scene before. The debt buildup, the optimism, the denial, the slow leaks turning into cracks. The setup doesn't just look familiar, it looks almost identical. Different year, same fuse. If you really want to know where the story is heading, stop watching what the public is doing and start watching what the winners are doing. Crashes don't sneak up on the people who understand the system. They prepare long before the headlines turn scary, long before regular people even feel the first tremor. And right now, the quiet moves of big money are telling a very different story from the one on TV. Hedge funds, the same ones that made billions in 2008, are loading up on put options at levels we haven't seen in years. A put is basically a bet that something will fall. And the smart money is placing those bets like they know what's coming. While everyday investors pile into whatever's trending, hedge funds are quietly building parachutes. Billionaires are doing something similar. They're shifting their wealth into cash, short-term treasuries, and safe haven assets. People joke about rich guys being paranoid, but they don't move billions unless they see smoke. When the crowd is greedy and the powerful are cautious, history says to pay attention. Private equity firms are raising record amounts for distressed funds, also known as vulture funds. They're literally getting ready to buy failing companies, failing buildings, failing debt the moment the system cracks. This is the same play they ran after 2008 when foreclosed homes became billion-dollar rental empires. Moves like this don't happen by accident. They happen because these firms expect deals, and deals only come from crashes. Insider selling executives dumping their own company stock is now at the highest level since right before the dot-com bubble burst. If your own CEO is selling, what does that tell you about the future? And commodity giants, the old school titans of oil, metals, and shipping, are betting heavily on global volatility. They don't need the economy to boom. They just need chaos. And they're positioning for exactly that. Put all of this together, and the picture becomes clearer. The surface looks calm. The headlines look calm. Even the markets look calm. But beneath that, the people who never lose are quietly stepping back, quietly hedging, quietly preparing for a moment they've seen many times before. It's the silence before impact, and the winners are already moving into position. If history is a loop, then 2025 is the next turn of the wheel, and the playbook the insiders will use is already in motion. It's the same pattern from 1929 and 2008, just upgraded for a world drowning in higher rates, record debt, and markets pretending everything is fine. If you zoom out, the moves look almost choreographed. This is exactly how money behaves when the people who never lose expect blood in the water. The first step is simple. Short what's weakest. In 1929, it was inflated stocks. In 2008, it was subprime mortgages. Today, it's the sectors suffocating under debt, regional banks choking on commercial real estate losses, office towers worth half of what they were in 2019, and zombie tech companies that survive only by borrowing more money. Hedge funds have already started placing big short positions here, betting these cracks will become breaks. Next comes the feeding frenzy. When something falls apart, insiders don't run, they shop. Distressed real estate, bankrupt companies, discounted assets that regular people are terrified to touch, these become opportunities. Private equity is already raising billions, specifically to buy whatever collapses next. Buildings no one can refinance, companies drowning in loans. That's a clearance sale for anyone with cash. The third step sounds strange, but it's powerful. Using high interest rates as a weapon. When money is expensive, weak companies can't survive. Strong players, the ones with cash, can. So the giants wait. Every month that rates stay high is another month more competitors fall to their knees. Then comes the deflation trade, betting that demand, prices, and growth will drop once consumers crack under the pressure. You're already seeing early signs. Retail sales slowing, delinquencies rising, savings gone. Smart money is positioning for a world where things don't get more expensive, they get cheaper because people can't afford anything. And finally, the moment of maximum fear. When the public panics and sells everything, that's when insiders buy back in. Stocks on sale, real estate half priced, companies begging for capital. It's the same pattern that turned 2009 into a gold mine for those who stayed patient. Zoom out, and the picture is crystal clear. Money is shifting like a predator circling the water, waiting for the exact moment the system stumbles. And when it does, the people who prepared will profit the most. Crashes have always been explained to the public as shocks, accidents, or unpredictable events. But when you study history closely, the pattern becomes impossible to ignore. Crashes aren't random. They're the end of a cycle that rewards the prepared and punishes the distracted. In 1929, it wasn't fate that made Jesse Livermore rich while millions lost everything. In 2008, it wasn't luck that allowed a handful of investors to profit while the housing market collapsed. And whatever happens in 2025 won't be destiny either. It will be the same forces repeating themselves because the people in the system behave exactly the same way. We inflate. We deny. We ignore the warning signs. And when reality hits, most people act shocked even though the setup was visible the whole time. The cycle only feels mysterious if you never learn to recognize it. But once you see it, you can't unsee it. Debt builds, confidence peaks, insiders hedge, the public stays optimistic, and the smallest spark sets off a chain reaction. It's not magic, it's human nature. But here's the part that matters. Understanding this pattern isn't just for billionaires, hedge funds, or insiders. Knowledge is leverage. Knowing how the cycle works means you can avoid the traps that hurt the people who always get caught at the worst possible moment. You don't have to chase hype. You don't have to buy at the top. You don't have to panic at the bottom. You can stay calm while everyone else is losing their minds. History doesn't repeat to punish us. It repeats to warn us. And right now, the warning is loud. The debt, the denial, the insider moves, they're all pieces of a familiar puzzle. But the difference this time is simple. You're watching the pattern with open eyes. You understand the blueprint. You know what comes next. And that knowledge, more than anything else, is what keeps you from becoming the victim of someone else's profit strategy.